Well, hi everyone, and welcome to the Buffett and Beyond weekly ETF video letter, and this is Saturday, April 22nd, 2023. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And this week, we're going to start out by looking at some momentum indicators put out by the Decision Point people. And they have the S&P 500 up here, and we are looking at this little part right in here when the market made a high, came back down, and then made a higher high, and is just starting to come down. Now, this is in conjunction with our Saturday market recap letter, so you're going to see some of the same things on that, but with different indicators. So here is a price momentum oscillator, which is the Decision Points people's own oscillator that they made up. And what they are showing now down here, this is a breadth oscillator. So as the market goes up, and don't forget, we're again looking at this point in here where the market made a high, came back, and then made a higher high. Well, what happens to the breadth? Now, what's the breadth? Advancing issues and declining issues. So here we had a lot of advancing issues on this first breakaway or break up to this high here. And now this time over the past couple of days, look what's happening. Advancing issues much, much lower. Then when we come down here, we're looking at a volume indicator, which they use. And the positive volume was this height when the market made this high up here, and now it's this height. So what we're seeing are bearish divergences, so keep that in mind. Down here they have stocks above their 20-day moving average in this point here, and now that we're even at a higher high in the market, we don't have as many stocks above their 20-day moving average, so that's falling off. And then also, with the price momentum oscillator on the individual stocks, we are looking at this height over here, and now we're down to this height. So with the market making a higher high in this area right in here, all of these indicators that the Decision Point people use are showing a lower high. So again, the market making a higher high in here, and are these indicators, their indicators, showing a lower high. Now let's look at some of our favorite ETFs. When we look at the communications ETF, which we haven't looked at in a very, very long time, we are looking at this XLC, the communication services, making a high in here, but look what's happening to our intermediate term indicator down here. It's making a lower high, and it has turned down. That is not a good sign, no matter how you look at it. Trying to look at something positive in here, and I don't see it. So let's look at the financial sector, which was doing very, very well, and we are just seeing it bounced off. It couldn't get through that 200-day moving average right in here. This indicator up here is now turning down, and we are just seeing a slight rolling over here. So this is kind of like the strongest ETF, and still it doesn't look good, being rejected by the 200-day moving average and the 50-day moving average coming down and breaking, just starting to break below the 200-day moving average is not a good sign. That's a very, very bearish sign, as a matter of fact. So we're waiting for this to turn down. Let's look at the energy. Well, energy, same thing. Same thing. We have a lower high in here, and we have the intermediate term indicator turning down. Up here, we have our relative strength indicator turning down. Now, folks, I might sound like a broken record, but here are the QQQs, and this is what? The NASDAQ 100 minus the financials. So this is an index that we look at a lot because a lot of the technology stocks and semiconductor stocks are in the QQQs. We can see already that it has broken down here. It has broken to the downside. That's not a good sign. So this market, or this index, making a higher high in here, this index making a lower high, so you can really see the divergence here. This index making a higher high, this intermediate term indicator making a lower high and having broken down. The black line has crossed over to the downside over this red line. The SPX, which we're going to look at in our market recap letter, we can see the same thing. It didn't reach a higher high, but we're looking at this area in here where it reached a higher high. But this indicator down here, intermediate term indicator, is just starting to cross over to the downside. Now it hasn't done it, but I'm recording this before the close on Friday, but this is ominous. And don't forget, let's go back to the QQQs. The QQQs have broken down. Now let's look at the semiconductor ETF. Well, folks, there's not much to be said about that because now it is below the 50-day moving average and continuing down, and this indicator down here has continued down. Oh, a couple of weeks ago already, so we were looking that maybe it was breaking to the upside a little bit, and then all of a sudden it broke down. This is one of our favorite ETFs, the semiconductor ETF, and the 5 or 7 stocks, because in one model we have 5 stocks, and the next model we have 7 stocks. And then when we look at the technology sector, same thing. This indicator, intermediate term indicator, has broken down. And the healthcare sector is the best looking of all the ETFs, and is actually up as I'm recording this, but still it topped out, and this intermediate term indicator is just about to break down here with the black line going down over the red line. So that's not a very, very good sign. And this is one of the stronger ETFs. And remember oil, the oil and gas exploration production ETF. Well, all I heard all week was, oh, the price of oil going up, price of oil going up. Well, folks, it certainly doesn't look good when you look at a chart. And it has the intermediate term indicator has broken to the downside. So the bottom line here with all these ETFs, if you are trading them or trading the stocks in them, you know, our top 5 stocks, it might not be a bad idea to either take on protection, or if you're trading, just get out of them. Or some of you even go short. Now I want to tell you, on Friday afternoon, we went short just a few shares of the SDS, and that's the inverse S&P 500. Just a few shares. We went short on that. And if the market is down Monday again, and if the market closes today, as I'm recording this on Friday, closes down, and Monday looks like a down day, we're going to go short in the trading portfolios. And right now we're flat. This morning we got out of our last SPY call because we caught the rally, and now it is turning down. So folks, it doesn't look good this coming week. If you're trading any of these ETFs, I would think about either protecting them or just getting out of them, because gee, what do you have to do to get back in? Just press a button. What do you have to do to get out? Just press a button. And the worst you could be is that we're wrong and the market continues up. But right now, there's a lot of things telling us that the market's going to go down here for a while. We don't know if it'll be a couple of days. We don't know if it'll be just during earnings season. And a lot of earnings are coming out this coming week. And we're talking about the tech earnings and the semiconductors. And right now, things do not look too good. So bottom line is, if you're a long-term hold, or long-term holder, just go to the beach or go for a walk or something. But if you're short-term trading, this is a good time to be protecting yourself. So folks, you have a good weekend. And remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And right now the market is saying we might want to take a rest. All right, folks, have a good weekend. We'll see you next week.